Okay, so imagine this. You've been doing everything right. You opened a brokerage account. Maybe it was Fidelity, maybe Vanguard, doesn't matter. You set up automatic contributions every month. You picked a fund that sounded solid. Actively Managed Growth Fund. The name sounded professional. It sounded like someone smart was in there, working hard, fighting for your money. You felt good about it. You told yourself, I'm not like those people who just let their savings rot in a checking account. I'm investing. And technically, you are. But here's the thing. There's a very good chance that right now, at this very moment, a fee so small, you've probably never even noticed it, is quietly, methodically, and permanently destroying a massive chunk of your future wealth. Not a scam, not fraud, completely legal. And the reason it works so well is because it's designed to be invisible. I'm talking about expense ratios. And by the end of this video, I promise you, you will never look at a fund the same way again. Look, I know what you're thinking. A fee? Come on, I've seen my expense ratio. It's like 1%. That's nothing. And that's exactly what they're counting on you thinking. Because 1% sounds like a rounding error. It sounds like the cost of doing business. It sounds totally, completely harmless. But here's where the psychology gets dark. Your brain is wired to think in terms of dollars taken out of your pocket today. If someone walked up to you and said, hey, give me $1, you'd notice. You'd feel it. But when a fund company takes 1% of your total assets every single year, compounded, silently, automatically, your brain doesn't register it the same way. You never see a bill. You never get a notification. The money just doesn't grow as fast. And you have absolutely no idea what you're missing. This is not a small problem. This is the biggest stealth tax in personal finance. And almost nobody talks about it in plain English. Let me give you a number that I want you to actually sit with for a second. Vanguard, one of the biggest investment companies on the planet, published research showing that over a 40-year period, a 1% annual expense ratio can cost you roughly 25 to 30% of your ending portfolio value. Not 25% of what you put in. 25 to 30% of everything that would have been there at the end. We're talking, in many real-world cases, hundreds of thousands of dollars. Gone. Silently. Without a single withdrawal. Without a single mistake on your part. Just gone. Consumed by a fee you barely knew existed. Morningstar has been publishing research on this for years. Their conclusion, over and over, is this. Expense ratio is the single most reliable predictor of a fund's future performance, not the manager's track record, not the fund's 5-star rating, not its name, the fee. Because a fund can't control the market. But the fee comes out regardless of whether the market goes up or down. It's the only guaranteed thing in an uncertain game. Okay, so let me make this real. Let me walk you through the math, because once you see it, you literally cannot unsee it. Two people, same age, 25 years old, both invest $10,000 and never add another dollar. Both earn the exact same market return. Let's say 8% per year, which is roughly in line with long-term U.S. stock market averages. The only difference? Person A is in a fund with a 0.03% expense ratio. That's basically a Vanguard or Fidelity index fund. Person B is in an actively managed fund with a 1% expense ratio. Pretty common. You've probably seen funds like this. Fast forward 40 years. Person A, $204,000. Just shy of it. Person B, $148,000. That's a $56,000 difference on a $10,000 starting investment with identical market returns. The only variable was the fee. And here's what really hurts. Person B didn't just lose $56,000. They lost $56,000 that would have kept compounding. That's $56,000 that was silently rerouted year by year, from their future and into the fund company's pockets. Now scale that up. Most people aren't putting in $10,000 once. They're putting in hundreds or thousands every month for decades. Run those numbers, and we're not talking $56,000. We're talking life-changing sums. A new car, a college education, a decade of retirement. Vanished. Here's a metaphor that I think makes this click. You know those tiny holes you sometimes find in a garden hose? Not a big gash, just a pinhole. You turn the hose on and most of the water gets to the garden, but over an hour, over a summer, over years, you've lost an enormous amount of water you never noticed leaving. Expense ratios are that pinhole. In the short term, you can't see it. In the long term, it quietly drains the thing you were trying to build. And the cruel part? The hose doesn't patch itself. The pinhole doesn't shrink. It's there every single day, doing its job, whether the sun is shining or it's raining, whether the market is up 20% or down 30%. The fee doesn't take a year off. The fee doesn't share your pain during a crash. It just keeps taking. Now let's talk about the thing that makes this even more infuriating. Because I could almost forgive the fee if the funds charging it were actually delivering better results. Like, okay, if you pay a premium and you get a premium outcome, that's a deal. That's capitalism working as intended. Except, they're not. S&P, Dow Jones Indices, run something called the SPIVA report. That's S&P indices versus active. And they release it every year. The numbers are consistent to the point of being embarrassing. Over a 20-year period, roughly 90 to 95% of actively managed funds underperform their benchmark index. That means the professionals, the people charging you 1%, sometimes 1.5% or more, are 9 times out of 10 doing worse than if you just bought a plain index fund and done nothing. Think about that. You are paying more to get less, consistently, over decades. And the fund company still gets paid whether they beat the market or not. There's no refund policy for bad performance. No, sorry we missed the benchmark, here's your 1% back. Nope, the fee is the fee. Win or lose. And look, I want to be fair here. There are some actively managed funds that have beaten the market over long periods. They exist. But here's the problem. Identifying them in advance, before they perform well, is nearly impossible. Even funds with great 10-year track records frequently revert to underperformance in the next decade. So the strategy of find the good active manager sounds smart in theory and crumbles almost every time in practice. The data is not ambiguous on this. So what do you actually do about this? Here's the playbook. And it's simple. Almost aggressively simple, which is the point. Step 1. Go look at every fund you currently own. Not the name, not the rating, the expense ratio. It's usually listed right on the fund's page on whatever platform you use. If it's above 0.5%, you need to ask yourself a very serious question. Is this fund actually beating its benchmark after fees? Not before fees. After. If the answer is no, and statistically, it probably is no, you're paying for nothing. Step 2. Consider moving to low-cost index funds. Vanguard's S&P 500 Index Fund, VOO, has an expense ratio of 0.03%. Fidelity has funds at literally 0.00%. Zero. No fee. These funds don't try to beat the market. They just own the market. And because most active funds don't beat the market anyway, owning the market is, paradoxically, the elite strategy. Step 3. Check for other fees hiding in your portfolio. Expense ratios are the big one, but also look for 12. B1 fees, sales loads, and redemption fees. And step 4, and this one is important, don't assume your 401k is safe. A lot of employer 401k plans are loaded with high fee funds because the plan administrator negotiated a bad deal, or worse, a deal that benefits them. You may not have full control over what's offered, but you can always choose the lowest fee option available in your plan. Every basis point matters. Here's the thing that I want you to really take away from all of this. The wealthy, the people who actually understand how money compounds, they are obsessed with fees. Not because they're cheap, because they understand math. Warren Buffett, in his will, reportedly instructed that his wife's inheritance be put into a low-cost S&P 500 index fund, not a hedge fund, not an actively managed portfolio. You didn't get into investing to make a fund manager rich. You got into it to build something for yourself, for your family, for the version of you that exists 20, 30, 40 years from now. And that future version of you, they can't come back and tell you what they lost. They can't show you the account balance that should have been there. You won't see the number that disappeared. But you can decide, right now, today, to stop the leak. Go find your expense ratios. Run your numbers. Make the switch if you need to. It takes maybe 20 minutes, and the impact plays out for the rest of your life. The market is unpredictable. Fees are not. And that is exactly the one thing you have complete control over. So use it.